Greetings, traders from all around the world. Thank you for joining me yet again. Chris here, bringing you another survival guide episode. Today, we're going to be covering chart patterns. This is one of the subjects that is extremely enjoyable for me because those of you that know me know I am a strongly technical analysis-based trader myself. So, without further ado, let's dive on over into the material and learn a thing or two about some chart patterns. Beginning at the beginning, we must start with the definition of what a chart pattern is. A chart pattern is nothing more than a way of identifying a particular path displayed by the historical price of an asset as it is plotted on a chart. And to be a pattern, naturally, it has to have occurred more than once in the past. The idea is through the use of past statistics, we are able to potentially show what is likely to happen when the market exhibits this type of behavior again in the future. In the trading world, there's two general categories in which analysis falls. We have technical analysis, and we also have fundamental analysis. Analyzing chart patterns falls under the technical analysis category. And technical analysis is nothing more than the study of past market data to forecast the direction of future price movements. This process is considered to be the brother of fundamental analysis. On the opposite side of the coin as technical analysis, we have our fundamental analysis. And fundamental analysis is the process of analyzing the intrinsic value of an asset. This entails the study of economic growth, inflation, credit cycles, interest rate trends, capital flows between countries, labor and resource utilization, demographic trends, central bank and political policies and behavior, geopolitical matters, consumer and business trends, and soft data such as sentiment or consumer confidence surveys. So there's a lot that goes into the fundamental analysis side of everything, and there are some things that I probably didn't mention here as well, but I wanted to give you guys a strong example of what fundamental analysis is at its core. Conceptually speaking, the patterns that an instrument's price forms can help display the transitions between upward and downward market trends or their continuation, which is important to remember as well. Technical analysts usually find that analyzing chart patterns is a strong way to potentially identify or confirm supply and demand, as well as support and resistance levels. When we throw patterns into categories, there are two broadly accepted types of patterns, with a third category being a little bit more controversial. The first category would be continuation patterns. Continuation patterns are something along the lines of if we see the market trending upwards and a continuation pattern arises, we would expect at the end of that pattern that the market would continue trending upwards. Then we have reversal patterns. Reversal patterns, just like the continuation name implied, reversal patterns imply that if the market was trending upwards and a reversal pattern arose, we would then expect at the end of that pattern for the market to begin trending downwards, which would be changing direction or reversing. And then the third category, that is a little bit more controversial, would be the bilateral patterns category. The bilateral patterns category implies that when these patterns arise, we may see market volatility increase in such a way that we may see price go both directions a great deal. Now we're going to go ahead and move over to some on-screen examples of some of the most commonly accepted and recognized chart patterns out there. The first pattern on our chopping block is the ascending triangle chart pattern. This is a pattern where we expect resistance to remain flat with price action, while support continuously rises into this area of resistance. The expectation is that price will ultimately have nowhere to go as the pattern continually tightens on itself, leading to a breakout. After the breakout, we naturally would expect price to continue rising as we already had bullish momentum going into it, with our support levels continuously getting higher along the way. Just like we have an ascending triangle pattern, we also have a descending triangle pattern. It's going to be the same thing with the rules just inversed. We're going to have the lower highs continuously getting lower, while we have a support area that is holding steady. This causes price to tighten and ultimately break out with an expectation that the market will continue in a bearish manner lower. Our next triangle-based pattern is the symmetrical triangle pattern. This is also another pattern that is very similar to the first two and very common throughout a regular trading day on most assets. The difference between this and the first two is we actually have both the resistance getting lower and the support getting higher at the same time. Essentially what happens is it puts a squeeze on price as it bounces back and forth from the support and resistance getting closer and closer until ultimately we have a break, and we'll expect price to go in the direction of the break, which usually is a continuation style. That means if the market was trending upwards going into this pattern, we would expect a break to the upside with a continuation of bullish trajectory. The cup and handle chart pattern is a fun one both to say as well as identify. Once familiar with this pattern, it usually stands out pretty well on any given chart. In this scenario, we are going to have price rising higher, where we then see it reach a plateau, followed by a sell-off. Then we have sideways activity with a support drawn at the bottom, where then new buyers enter the market, pushing price higher. After price goes higher, we then have a short sell-off yet again, attempting to push price back down. But unfortunately, the sellers fail, causing the handle to be formed, followed by a bullish run thereafter. Our next pattern is the diamond top and bottom variation. I only have a picture here of the bottom, and that's what's on screen, so let's talk about that one first. So the diamond bottom is going to happen when we see an area of support broken, leading to a drop in price followed by another area of support. This is going to be the first point to our diamond. As support is built at this area, we then expect to see price rise, where we'll then hit another wall, resistance forming, which leads to a downturn in the market, where we then set an even lower low and another area of support, triggering price to then rise back up to an area that should be roughly similar to where price initially rose to. After this, we're going to drop back down and create a higher area of support than our center point, working our way back up to where we're finally going to break out of our diamond and look for some long opportunities if we're trading a diamond bottom. The diamond top variation is going to be this exact image, just flipped the other way around, which means we would look for shorts with the diamond top. Moving along, our next pattern is going to be the double bottom chart pattern. The double bottom usually occurs at the peak of a downtrend market movement. This is a pattern that usually would indicate the start of a bullish trend. Our first requirement is for price to hit a new low. After hitting this low, support is built, causing the market to go up temporarily, where it then finds an area of resistance. After finding resistance, we then need the market to come back down and find support yet again. After the support has been found again, this creates our second bottom, hence the name double bottom. We then want price to rise and break the previous area of resistance to the left, which represents our neckline. At the break of the neckline, we expect bullish activity to follow. Our next pattern is going to be the inverse of the double bottom, and naturally that would mean it is the double top. The double top is just like the double bottom in the sense that it is also a reversal pattern. We want price to hit a new high, finding resistance before heading back down and creating an area of support, which would begin our neckline. After the neckline is created, we want to see price rise to another top, hitting resistance around a similar area as our previous resistance, sending price down one more time for it to finally break the neckline, where we would be anticipating a short opportunity. Next, we have the falling wedge pattern. This is a fun one because it's kind of confusing for me to explain to traders at first, because it requires a temporary downtrend and it then reverses at the end of the pattern, but it's not a reversal pattern. It's actually a continuation pattern at its core because price is continuing with the overall direction of the market. So this means price was rising before it started falling to create the pattern. At the end of the pattern, we expect a break and a continuation of the overall bullish trend. What we want to see is support getting lower all the way down, and we want to see the resistance area getting lower as well, putting a squeeze on the support, very similar to our triangle patterns at the beginning. The rising wedge is just going to be the inverse of the falling wedge, which means we have a downtrend going into the pattern. The pattern represents a temporary bullish move where the resistance and the support are squeezing into each other until ultimately the support breaks, leading to a return to bearish activity. The flag pattern is another wildly popular pattern. This is a bearish variation, and naturally we have a bullish variation waiting for you as well. So what we need is a downward push in the market where we have a very consistent decline. We don't want to see a whole lot of bullish activity along the way down, and this creates our flagpole. After the flagpole comes the flag. And to create the flag, we want a slight incline in price. We want price to temporarily start pulling its way back upwards, trading in a range-bound manner, giving us a tight box that we can put around the pattern. After this happens, we'll be looking for the break in the pattern and a return to bearish activity like we had going into it. This is a pattern that provides traders an opportunity to add more contracts into an already working position. Our bullish version of the flag pattern is obviously quite similar. We want a smooth flagpole going up, followed by some slightly sideways to downward range-bound activity creating our flag, followed by a break that leads to more bullish activity, giving us an opportunity to add to an already working bullish position. Next comes my all-time favorite pattern, the head and shoulders chart pattern. This is a pattern when used and identified correctly can be extremely powerful. The first thing we're looking for is a shoulder that is a new high created in the market. After the shoulder is created, we need some resistance to send the market back down, where support is then found, beginning our neckline process. After support is found at the neckline, we need a push that gets us even higher than our shoulder, where we find resistance again, creating the head. After the head is created, we need the market to push back down, touching our neckline yet again, bouncing off of it, using it as support, and pushing towards our second shoulder. After our second shoulder, we're expecting price to come back down to the neckline, but this time, this is where we're on the lookout for the break. At the break, we're expecting price to continue hard in the direction of the break. The pennant chart pattern is quite similar to both the symmetrical triangle as well as the flag pattern. The key exception and thing to look out for with a pennant pattern is we want a sharp incline or a sharp decline at the beginning of the pattern. And when we say sharp, that is relative to the way price was trading before the pattern began. In this scenario, we have a sharp incline, followed by some resistance, followed by some higher support, followed by some lower resistance, followed by some higher support, followed by some lower resistance, ultimately leading to a break and a continuation in the direction of the trend that existed before the pattern began. Our final chart pattern of the day is going to be the rectangle chart pattern. This is a pattern that looks very, very similar with the top and bottom variations. The only difference is how the pattern enters it. With a bottom variation, price will be traveling down before it enters, and that is what we have on screen. The top variation would be the same thing, just the other way around. Price would be traveling up before it begins its consolidation period. During the consolidation period, we're going to see price kind of aimlessly work its way back and forth, finding support and resistance along the way, much like a flag, but with no incline or decline that's readily apparent. At the end of all of it, we're looking for a break that occurs in the direction of which we came into it. A bottom, we're hoping for a break to the downside, leading to some possible sell activity. A top, we'd be looking for a break to the upside, leading to some possible buy activity. In conclusion, I'm very excited to see how many of you have your eyes open to some of the patterns that are hiding in front of you and have been hiding in front of you in plain sight all along. There are patterns that are occurring every day in the market that are not being taken advantage of by those that don't see them. As with everything, experience and time with practice is a crucial aspect to the results that we can expect to achieve with any trading strategy. I always encourage using a demo account when trying anything new. But thank you for joining me yet again, folks, during this survival guide episode. It has been a pleasure as always. Please make sure you hit the like and subscribe button below to make sure you get alerts when we come out with new videos. Thank you again. Over and out.